Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smallenberger, the CEO here, will be your host as you go behind the designs.
All right, welcome back to the podcast. In today's episode, we want to do a debrief, kind of a post-mortem of the 2023 tax season. For this episode, we have Steve Smallenberger joining us. He is our CFO and our tax specialist, so he's been in tax season. Welcome out of tax season, Steve.
Thanks, Michelle. Thanks for having me. Good to be back amongst the living.
Yeah, exactly. I think we've joked about that a couple of times.
Yeah, tax season always feels like finals week. You're always trying to get that A on the test, and it lasts for several months. So once 15th comes, it's kind of like a crash. Like, all right, summer break now.
Yeah. So I recently heard that, just kind of in general, that people tend to say, well, I didn't owe any taxes as long as they didn't like owe anything with their tax return on April 15th, which we would say, wait, that's not true. What do you say to that?
Yeah, that kind of goes into the psychology of finances, especially taxes. If you're not writing that check, you're not making that payment, it feels like you don't owe, even though you've probably had withholdings and payments coming from all different sources. So yes, writing a check is always, people think of that as a win, but also getting money back, they think of it as like a lottery ticket almost, like they've won, they have winnings now. It
is interesting because some people who have to write a check are like, great, they didn't take out more than they needed to. Like I kept my money all year. And then some people don't want to write a check. It is so interesting how everybody's different.
Some people will want to have a refund because it's kind of a forced savings. I wasn't able to save that myself, so I let the government save it for me, and now I'm getting it back. Others are like, I want to get as close to zero as possible. So if they're $1 over or under, they see that as like, I zeroed out. No free interest loans to the government. Others are, they will owe, and they're like, well, that's part of making money is owing money.
Yeah. And they're fine just paying the difference, of what wasn't withheld then. No, I think it's so interesting. Well, tax season for us is we kind of view it as kind of like a result season. It's kind of like a grade for how well you planned throughout the year. So it is kind of an answer of, did I withhold enough or not? So there is something to that. So we kind of wanted to share our perspective as financial advisors. How did people do? How do we feel like we did, even helping clients? This is how we really kind of reflect on this is, did the things work? All the planning work? Is that what we were expecting? Because we're doing that throughout the year. So we're going to kind of share this. What did we notice? And then how can you prepare for your annual tax checkup for next April, but starting today? So if you didn't like what you had, the results you had or anything like that, we're going to dive in. So hopefully there's something here that you can pick up and learn from today's episode. So let's just start, I guess, at the beginning. Take us kind of back through tax season the last few months. What were things that you noticed? How many tax returns did you do? Maybe just start us off there.
Yeah, so as far as our firm, FDS, we prepared more tax returns this year than ever before. That was 186. So start off with just family and friends, and it's been word of mouth and clients referring clients. So thank you for everyone that has referred family and friends and trusted us to help them. So 186 tax returns done, a handful, maybe half a dozen or so still in extension, waiting for final information. But yeah, 180 out the door. Tax season was kind of a whirlwind. What we were experiencing this year is more 1099s. So whether that's from Schwab or your bank or Vanguard, Fidelity, whoever, we're tended to provide those later and later. So clients were getting information later, which meant they passed it on to us later, which meant just a lot of very concentrated, a lot of numbers being worked on at the very end of tax season. So I kind of think of tax season for us, it starts maybe right after Thanksgiving, getting everything prepped and ready. December for sure, we're sending emails. This year we sent out an RSVP list to clients, just asking them to let us know if they were planning on returning and how we could prepare and be ready for that. So 61% of our clients let us know ahead of time that they were coming back, which just allowed us to have the resources to work on those. But yeah, so information coming later just meant it was a lot happening, not in January, February, but more late February, really March and April. So a month and a half really is when all the work had to get done.
Yeah, I think that's one of the interesting things. I do think that we see this and we hear people, new clients that come, they kind of, talk about, my accountant isn't doing it anymore. And so they come on board. And I think that's it's common. And we know, people cycle through or maybe have one accountant for a season and then another. But I think that it's helpful. What we're trying to say is, hey, we're ready for you. Tax season's coming. We did your return last year. And so, hey, we're ready. We want to be ready for you. So just let us know that you want us to do it again. And so I think hopefully, people kind of feel like, okay, I have someone I can depend on and trust in. And hopefully, even anyone listening feels like they have that too. So I guess it's just letting people know, like, you can have that.
Yeah, what we try to do is not make it a transaction relationship. I mean, it's a one-time thing, come in, get it done, leave. It's more a relationship. So clients don't leave. And when we're receiving maybe a new prospect or someone's reaching out to us, it's because maybe their past preparer passed away or is retiring. Few times there was something wrong or I didn't trust them, but not too often. A lot of times there's relationship and history. And we promote that and want that.
I think that it can actually be valuable for people year by year because a lot of things stay the same for most people. And so then your accountant can say, okay, we've got all your documents or we don't. So
yeah, oftentimes when they'll be working with us with their investments or financial planning or those projections, they're like, most of my financial life or everything about me already. Why don't you just prepare my return too? That way I know it's all the same. There's not two different stories going on. And that's oftentimes how people will come on.
Yeah. Yeah. So I guess kind of along these lines of just like kind of information coming in, that's something that this year, I guess we would say probably isn't different than last year, or in years prior. There are always kind of corrected documents.
Yeah, there were a few custodians, meaning where the 1099s were sent out and then corrections were made. And that's not due to the custodian. That's not due to Schwab or Fidelity, Vanguard. That's due to the underlying investment just having to re-report some earnings. So there were a couple. Usually they go out late February. There were a couple repeats or revisions in early March. So, yeah.
Okay. Yeah. All right. What other things did you kind of notice, I guess, as you were preparing returns, I guess, since you do, so many, one after another, were there things that you commonly saw, things that stood out to you as, okay, this was a little bit different this tax season that I noticed?
Yeah. A large majority of our clients are very charitably inclined, meaning they want to support organizations, maybe not-for-profits, churches, in the community. So our clients are very giving and supportive of that. So we're seeing a lot more clients use donor advised funds or charitable accounts. So for example, all our investments are at Schwab. We have an account that we'll set up for clients specifically at Schwab. And it works simply like charitable checking account. You fund it, and then from that account, you then disperse the gifts to the different organizations. The nice thing about it, and where we've seen a lot of clients be supportive of opening those accounts, is it eliminates any tracking of receipts. So all the organizations will still send you donation receipts, but you don't need to keep all of them. You simply keep the one donation of the money that you put into Schwab. And then that's what you turn in to your preparer. That's what is reported on the tax return. And the nice thing is we're seeing clients not only put cash into that account, but they're using appreciated stock, like appreciated positions like stocks or some bonds. They'll put that into the account and use that as their donation.
Yeah. And so then basically that gain, you're not having to pay tax on the gain. You just you gift the stock into that account. And now you get the tax deduction from the charitable contribution, but also you didn't have to pay tax on that gain. So it's kind of two strategies put together into one to really benefit you. But also it's making your life easier in tracking, the money that you're giving, which is one of the things that we encourage people to do. We want them to live more and give more. So that is that second piece there where we're saying, yes, we want you to do this. Let's make it as easy as possible.
Exactly. Yeah. And Schwab has a great website. They have a number of resources where you simply log in, you pull down the drop list, you can find the
Mm-hmm.
charity that you want to, you can send the check or funds to that charity. You can do it anonymously if you wanted. It's all very smooth. It can be set up periodically or recurring. So it's a win-win, especially for those that want to give and they want to do it easily and they want to kind of eliminate or reduce the tax reporting burden on them. But yeah, you're
Mm-hmm.
right. Like if they sold the positions or the stock themselves, they'd have to recognize the gain and then pay the charity and
Mm-hmm.
pay the tax. In this case, they're donating the stock. They're avoiding that capital gain, but they're getting the fair market value of that donation on the date they give it.
Mm-hmm. No, that's great. That makes sense. Talk us through another one, kind of non-cash donations. Anything, I guess that's the other way that people can give more. Anything that you noticed with those? Is that pretty common for people to do?
Yeah, just kind of in our culture these days, we're trying to be have less stuff. So
Mm-hmm.
oftentimes we'll be giving away clothes, maybe our kids outgrew, or sporting goods, or just
Mm-hmm.
furniture, any of that. So we're
Yeah.
thinking things here like Salvation Army, Goodwill, kind of those.
Mm-hmm.
So what you want to do there is that's reported as a donation on your tax return. So as long as you're itemizing, we're reporting that on Form 8283. If the value of all those goods that you give is more than $500, we just have to provide some more information. So we ask them to collect receipts, itemize or list out what those items were, how much the fair market value or kind of garage sale value of those items are, and then the date they donated it. What we find is often clients don't remember what they give. So we ask them, well, just take a picture, like
Mm-hmm.
make a pile in your living room before you give it, take a picture with your cell phone. Salvation Army and TurboTax also have a really helpful spreadsheet or online kind of estimator. So you can type in, oh, it was 3 t-shirts, couple sweaters, and jeans. They'll provide like that fair market value if it's well worn, like a fair market value, depending on um,
Quality, I guess, at the moment, like how
the
well used it was.
exactly, yeah, that's the word that
Yeah.
was escaping me. So the quality of the goods is it excellent, good, fair, or poor, and based on
Mm-hmm.
that, it provides then a dollar value. So
Mm-hmm.
that's one where clients sometimes will make that donation, but they don't. They're like, oh, it's not worth anything. It's not going to really benefit me, but it actually will.
Mm-hmm. All right. Um, one other thing I think that you had kind of mentioned, I know, as we talked throughout tax season, just kind of like paying, I guess if you have to pay online. So if that's paying online, is it by check? That was something you had kind of noticed like throughout tax season.
Yeah. So the IRS has a great website where they allow you to make a payment. So if you did owe, how do you make that payment? You can
Mm-hmm.
always send in a check, and we would provide a payment voucher that goes along with that check, and
Mm-hmm.
then you mail it in.
Mm-hmm.
Um, but things get lost in the mail. Things don't get recorded appropriately by IRS or Illinois Department of Revenue or whatever state you live in. So this year we were directing people to make those payments online. So I would provide a link. They would then go to the IRS direct pay, type in their banking info, type in the date that they want the funds pulled. And the same with Illinois. Illinois had a make a payment website. So we were directing clients to do it that way. That way it was at their convenience versus having the funds pulled through our software. Because once I pressed submit, there was no ability to change anything. So if their banking value changed, it could create issues. So we were directing clients to make payments on their own. That way they were aware of what needed to be paid, when they wanted it to be paid, and ensure the funds were there.
Mm-hmm. Yeah. Yeah. I think those were kind of like the ones that we noticed throughout tax season. Now I know that's kind of like as you're entering things, as you're seeing some of the things that we're going to talk about kind of in okay, now that tax season's done, kind of the follow up to that and these other
Mm-hmm.
couple sections, some of these will be, may also fit into that category. So I guess during tax season, these were kind of the few that you notice that are different. There's a lot of things that just stay the same. But one of the interesting things I think that's been surprising, this tax season or this follow-up is it's kind of like there's a lot of people receiving notices quickly, like already. And so let's talk about like kind of some of those common ones that we're seeing, which, may be surprising, may not. Sometimes we tell people you're going to get this because of a certain reason, but walk us through some of these that we're already seeing people get.
Yeah, so some of the ones that we were expecting, most of the ones that we've even heard from already aren't IRS related. They're Illinois Department of Revenue or state specific. The few that I'm thinking of are clients that sold a home here in Illinois and then moved out of state or just sold a home in general. The way the Illinois property taxes work, it's in arrears. So meaning you lived in the house last year and you paid the tax in 23. When you sell your home, you're able to then also claim the credit that you then gave to the buyer of the home. There's not only what you paid, but what you will be paying for what you lived in the home. So there's a disconnect between what the counties are reporting and what we're reporting on the tax return. So in that instance, we tell clients, you'll probably get a notice. They'll probably disregard the property tax credit. So Illinois gives you a 5% credit on your property taxes. So they'll probably disregard that and require you to verify or provide information. So in that case, we already have all that information. So we write a letter, we include the county, what's recorded at the county website, and then also the closing statement, send it to the Illinois Department of Revenue, and 30 days later it gets cleared up. That was one. And then the other is clients that made deposits into college savings plans. So Bright Directions 529. We received a couple notices this year just asking clients to verify or provide confirmation of what was deposited into those accounts. Even though on the tax return, we have to put the account number, we have to put the deposit info. Illinois is asking us to verify that.
I think that's something, and I think this is just a good reminder for people. One of the biggest things we always want to do is kind of take the fear out of taxes, because for some reason, it seems like this unknown, okay, in April, I'm going to do my tax return, or I'm going to have an accountant do it, and I don't know what the result's going to be. There's kind of this fear, this uncertainty around what the results are going to be if you didn't plan ahead or you didn't do any type of estimation before. And that makes sense. If you aren't, you don't know what it's going to be, because things can change. So I think this is helpful just to remind people, even if you do get a notice in the mail, from the IRS just saying, hey, we saw something on your tax return. Really what they're just saying is something doesn't match our records from what also came on your tax return, right? So it shouldn't necessarily drive fear. It's just we might need to give them some more information to prove that what we're putting on our tax return actually did happen, right?
Yeah, so most documents, think of your W-2 or your 1099 from your bank or from your investment custodian, those forms are also sent to the IRS and they're also sent to your states. So the states they basically already have a pre-filled out tax return exclusive of things like your charitable donations. So when there's a mismatch in any one of those columns, what you reported versus what they're reporting, oftentimes it's a computer-generated mismatch notice. And it just takes providing additional information to clear that up. But until you do, the burden is on the taxpayer to basically prove innocence until rather than guilt. That's the reason is there was a pure mismatch or an explainable difference. Once that's cleared up, then it goes away. But different from an audit where they're maybe randomly looking into something. Either you were randomly pulled or there was certain criteria on your tax return that kind of brought about a red flag for various reasons.
Yeah. No, I think that's a helpful distinction between an audit where this is just, hey, something didn't match. And I think that's why we kind of want people to realize, okay, we don't have to be afraid. You just basically follow up with more explanation and or maybe here's the closing statement, things like that to kind of prove it. So, yeah.
So things that weren't maybe questioned or required verification in the past are now, because individual states have their budgets aren't as flush as they were in the past.
Mm-hmm.
So things that they were giving as deductions or credits without verification are being more tightly maybe
Mm-hmm.
scrutinized or reviewed.
Yeah, yeah, and they want to make sure. Yeah, because I'm sure they have, yeah, they're seeing different things. So for various reasons, they're probably flagging, or their systems are better aligned with those things now, and so they can flag them easier. So that makes sense.
Mm-hmm.
Another one I kind of naturally think of, just, okay, I found out, did I owe or not, or did I get a refund? Now people are kind of asking the question, why did I owe so much, or why did I get so much back? Or why didn't I get, anything back? It's how can I adjust for that? So kind of estimating now, because the biggest place that this is affected is from your paycheck. So from your employer and what's withheld from that. That's kind of the biggest thing. So is there a way that people can look into that if they had to owe or if they got a lot back?
Yeah, so
Easily?
for those that still work, the IRS has a great tool. It's called a W-4 estimator,
Mm-hmm.
where you can go in and type in some basic information.
Mm-hmm.
I'm married. I have these number of children. Here's my income. Here's how often I'm paid.
Mm-hmm.
Here's what withholdings I'm currently coming out of my paycheck. Year-to-date information, and then it'll say, all right, based on this, we're projecting that you are under withheld or over withheld.
Mm-hmm.
And then you can adjust that. And what that means is you would then print out what's called a W-4, which is basically just, here's my elections for how much I want taken out of my paycheck, and provide that to your employer. And
Mm-hmm.
then your employer makes those changes, and you'll see that reflected shortly in future paychecks.
Mm-hmm.
For our retired clients, or those who don't have a employer or don't have a full-time job anymore, or maybe they do, but they have more investment or retirement income, we're projecting those out in either late summer, early fall with tax analysis. So we'll run basically a pro forma or a projected tax return, let them we'll then explain to them or summarize, yeah, it looks like you're on track, or we're going to have to increase your withholdings from your retirement accounts or make estimated tax payment. Yeah.
Mm-hmm. Yeah. And I think those are the things where it's like knowing kind of when you're earning income. So for example, I can think of people just here at the beginning of the year who are maybe, selling a big portion of stock, or maybe they're leaving their employer. And as part of that, they get like a payout of something. So some things do happen early in the year. And so naturally they're kind of saying, what do I need to do for taxes? And it is actually really good to pay attention. If it's early in the year, maybe they should be paying something in an estimated payment, before the next estimated payment is due. So I think those are things that throughout the year to be thoughtful of. So it is good to be asking it now. And even with kind of that W-4, you can always update that with your employer, then look at your next paycheck, see if that's more in line with what it should be. So you can kind of do like a trial and error, kind of see, and then see if the results look good once you get your next pay stub. But it is good for people to be thinking of.
Exactly. There's no limitation on how often you can change your W-4.
Mm-hmm.
It's not like your other maybe benefits through work where you can only do that during enrollment season.
Mm-hmm.
But this can be updated as often as your employer will allow. But you're right. Yeah, if there's some large life events or something changing, it's good to do that earlier so that you have more months as a runway until 12/31. That way we can make adjustments. We can plan accordingly. We have more time to kind of smooth things out than only having a month or two to figure out what next.
Yeah. So I think it's just good. It is good if you're thinking about that. If you kind of find yourself asking that question, it is a good one. And there are ways, just like you've described, Steve, if you're working, if you're not working, there are ways that you can adjust that or make changes if you need to here really towards the beginning of the year still, for the rest of the year. So that's helpful. Yep. All right. Another one, I think some of these I think come up because we kind of see more people, and I don't know if it's more people just kind of getting educated about finances, or maybe kind of more do it yourself. But IRA contributions, backdoor IRA, backdoor Roth, kind of some of these strategies we kind of see. Walk us through things that you notice on the tax return, because of something like that.
Yeah. So some things will provide a 1099. And some things will provide a contribution form. So in in what you're talking about specifically is IRA contributions. So
Mm-hmm.
when you put money into a retirement account, specifically a traditional IRA, a Roth IRA, there's a form that comes out, but it's not mailed until April 15th. So kind of after tax season. That's because you have until April 15th to make a contribution for the prior year. So that's one where, because we handle the investments, we're aware of those things. But when we're working with a new client, maybe we'll see that's something that they missed because they didn't get the form in time. So contributions into an account often aren't reported or accounted for correctly, or if at all.
Mm-hmm.
Sometimes when the contribution isn't recorded and then they make a distribution or a conversion, they're reporting it as completely taxable when it's a non-taxable event due to having basis or the backdoor strategy.
Mm-hmm.
So that's something we'll see, especially with someone that's doing it themselves, or a preparer in the past that either doesn't know how it works or wasn't aware a contribution was ever made.
Mm-hmm. Yeah, exactly. Yeah, some of these things, like you're saying, when there isn't a tax form that's generated that they get to then give to their preparer, that does make it tricky. And so the accountant is really kind of dependent on them to give them all the information. And so that can make it hard. So that's where it is important to either know what you've done throughout the year to tell them, or to know what you're doing so that you're accounting for it correctly.
Yeah, the hard part is sometimes we don't know what we don't know until it's maybe too late. So.
Mm-hmm. Yeah. Yeah. And so this is actually a really great segue into the next one, kind of this excess 401k, excess HSA. So this is when someone has put in too much because they don't know, or, they weren't aware of how much they could do. So walk us through, because that's another common thing you see.
Yeah, so there's certain accounts that the IRS has said, we're going to limit how much you're able to put in based on maybe your age, how much income you make, and these change from year to year based on inflation and just cost of living adjustments. But the ones that we're talking about specifically here are 401ks and HSAs, which stand for health savings accounts. There's instances maybe where you have a husband, wife, that they both contribute to their health savings account at work, but they haven't they've exceeded the limit based either individually or as a family. So we'll have excess contributions, or the case where maybe you changed an employer and you maxed out a 401k at one employer, and then you change to your second employer during the year and you start contributing to that 401k as well. Well, it's based on you as an individual, not per employer. So we'll have excess contributions that exceed the annual limit in those cases. And then that it requires a distribution or withdrawal to make it back to eligible limits.
Mm-hmm.
But yeah, that's if left unfixed, there's penalties and tax and all that on top of that.
Mm-hmm.
So that's where just knowing like how much can I do, where can I do it, what are the limits, and those change each year. So it's kind of a moving target sometimes.
Mm-hmm. Yeah. Yeah, no, I think that's helpful just to know that you can correct things. So if you find something like that, those are really great examples of if you switch employers, one employer doesn't talk to the other and know how much was put in.
They never will,
happen.
even if
Mm-hmm.
you told them. So it would be on you to determine have I exceeded the limit or how much do I have left. Yeah.
Yep. Yeah. But it's also helpful to know that if you find that when you prepare your return, it can be fixed. You just, it's best to do it right away. So fixing it when you're doing that return is good. Okay.
Exactly. Mm-hmm.
So you talked about this a little bit when we were kind of talking about the notice that, someone might receive from the state or IRS just kind of right away. You talked about kind of audits and how they're different than this. This is something that we are seeing, especially when people can live in one state or another and the state lines are very close and I can drive across the state line for my work. But I want to live over here, maybe because one state has better tax implications, like better tax rates or whatever. This is one I think that we're kind of seeing maybe more municipalities or states looking into and kind of ensuring that they're making sure that people have residency and what they're claiming is for the right state. So talk a little bit about audits, things that you're seeing, with, just in general that you're kind of noticing on that front.
Yeah, specifically when a client will move or leave a state of residence, certain states are following or tracking and even clawing back future income, saying
Mm-hmm.
this was earned while still a resident of our state.
Mm-hmm.
Some states that are doing this more than others would be like the West Coast, like California, or the
Mm-hmm.
East Coast, like New York,
Mm-hmm.
asking clients to really prove they're no longer residents. Have they made changes? Have they changed their ID, their driver's license, their registration to vote, their doctors, where their packages with Amazon are being delivered? Just really proving that they're no longer residents of the prior state.
Mm-hmm. And I think what we want to let people know is that, again, this is not to be afraid of, oh wait, I, counted something that I shouldn't have, but it is just a reminder of, if you're going to deduct something, if you're going to claim something, be sure that you have proof. So even when we're talking about giving, when it's not just a cash amount, when it's something where you're kind of estimating the value of something, be sure you have a picture or a receipt or something like that wherever you can, because then when they do come back and they say, hey, we're looking into this more, and sending you kind of an audit notice, can you send us your cell phone records to kind of prove some of these things, which they have asked for. These are just the kind of the level that they can go to, and this is why we always tell people, when you're changing a state of residency and you're moving maybe from Illinois to Arizona or anywhere, Florida, there are sometimes reasons, because some states do have more beneficial tax treatment. So as part of the planning, it does make sense to, and it also aligns with your goals. So when you're doing that, it's really important to make sure that you're saying, I'm a resident of this state, when you move there. And there's things that you can do, like changing your driver's license, making sure you're getting your mail, just pieces like that. And we always want to make sure clients are doing that, so that when something like this happens, it's really clear. And when you file a return, Steve, I know that you want to be sure that what you're filing, you can actually follow up with. If they came back, that you can actually say, no, I can prove it because here's the documents. And so It's just being able to prove it to that level.
Yeah, we've all read articles or things in the newspaper of Californians leaving California and moving to Texas, or New York residents leaving New York and going to Florida, and often because there's no state income tax. So that makes sense, and they're basically playing the numbers game. They're like, our tax rate will be incredibly different. However, they're still going to have a part-year tax return. They're going to say, I was a part-year resident of California or New York, and now I'm a part-year resident of Florida or Texas. When I'm preparing the return, I have to be able to document that. I have to be able to attribute what income was earned where. Yeah. I'm signing the tax return just as well as them. So everything has to be defendable should I ever be questioned. It's while it may be a great planning move, it also has to be well thought out and be defensible.
Yeah. And I think it's just a good reminder for people. I think a lot of people, so many things we can get online anymore. So it's just, if there's things that you're deducting or you're counting on your tax return, just be sure you're keeping records enough. They don't have to be paper copies, but even keeping computer records or scanning something in. So
yeah, or knowing the rules as well. Like how many days do I have to live in the state to be considered a resident? Even if I still have a home here in Illinois, but I want to be in Florida part of the year, do I have to live there 6 months and a day? How does it work? Like how many days? And knowing those things are also really important.
I think this is something, this is just one of these areas where we talk about, these are the reasons that someone would have someone else prepare their tax return, because it's kind of like, okay, I know enough. I know I'm earning income. I could probably figure it out. There's a lot of people that could figure it out, but they say, wait, I want someone else to do this for me. And it's for reasons like this, because you don't quite know everything. And I know a lot of times you'll have analogies where you'll say, this is why I don't do this, You want to share some of those, like how you kind of view this, how you think about it?
Yeah, so a good friend of mine would always say, like, there's a reason I don't drill my own teeth, because I don't want to hit that wrong spot and hit a nerve. I always think of it, even while I could look up and watch YouTube videos on how to change the brakes of my car, I would rather have the confidence knowing that when I'm driving myself or my family down the street, the brakes aren't going to give out and I slam into something. So that isn't a scare tactic. That isn't to say you can't do it yourself. You shouldn't do it yourself. But having kind of the confidence, assurance that someone else who does this on a regular basis is watching out for me and helping me is that's why we hire professionals for all different areas of our life. And often we say that there's those three criteria. I don't have the time, I don't have the knowledge, or I don't have the desire to do it. And that's why I hire that out. That's a perfect case here with financial planning, taxes, investments, all of that.
Yeah. And I think if you find yourself kind of wanting to use some of these strategies or you are using them, these are points where you could ask yourself, should I be getting help? To make sure that I'm reporting it correctly? So no, I think that's helpful.
Sometimes I even look at that myself. It's an ego thing. Like I have to ask for help and this should be something I know how to do. Well, that often isn't the case. Maybe it's I don't have the time to do it. Or, you know what, I can't be researching this all the time and staying up to date on all of this. So I need to outsource this area of my life. There's nothing wrong with that.
Yeah. Yep. No, exactly. No, just helpful reminders. All right. So these are kind of the common follow-ups now that we've seen some notices come back from the states or IRS. Those are common. But I guess now if we start to kind of think ahead for what planning can people be doing throughout the year, what things can they look ahead to kind of get the results they want? Something I even found myself telling people during tax season this year is that anyone could file your tax return. But if you want the results that you want and you're hoping for when you file your tax return, you need to be doing the planning all year. And so, you know, when you file the return, it's putting the information on the right line. And sometimes that just takes skill because you need to know where it goes. But you need to be doing the planning if you weren't happy with the results that you got. So I guess when we talk about some of these, one thing that I just noticed, you know, as people pass away and people inherit assets, whether that's through different types of accounts, that causes more complexity in a tax return than people are used to. So, for example, I guess walk us through, these are some things that even have changed with the Secure Act, like inherited IRAs. Talk us through like some things that people might notice with something like that.
Yeah, so kind of an analogy something we think through is you fail to plan, you fail to prepare, don't be surprised. If you're not prepared, like, why are you expecting a certain result if you had no idea you were going to get that? Yeah. So in some of these areas, we have the ability to prepare and plan and think ahead and kind of what is going to be the result of this event. So one thing that changed recently with the Tax Cuts and Jobs Act, or even more recently with the Secure Act, is when you inherit a retirement account from a spouse or a family member, or you're just listed as a beneficiary of a friend's IRA. The timing of when you have to start taking those out, depending if that was a spouse or not, are all changing. There's different rules on whether that can be rolled over into your own inherited IRA, or if that now has to be a non-spouse IRA and distributed over 10 years. There's what's called required minimum distributions, often known as RMDs, and those have to be happening either recurring annually or over a 10-year period. So there's a lot of things that have to happen whether you like it or not, sometimes based on age, sometimes based on the account. Things that we have to be considering.
Yeah, no, that's helpful. Another thing too, kind of along that same vein, is just trusts. You know, people are setting up trusts. So as they're caring for others, like their loved ones and their, you know, healthcare, they may set it up for different reasons so that there's assets to care for their loved ones, but only, you know, certain people can access it or manage it. Even trust returns, you know, just knowing and understanding the trust that you've created. And when you put money into that, then how that's going to be taxed. Is that going to create or cause another tax return to need to be filed versus just your personal return? So I think this is even something that we're kind of seeing more of because of, you know, again, just people inheriting assets or, you know, moving funds into a trust.
Yeah. Out of like the 186 or almost 190 returns we prepared, I'd say a dozen of those are entity related, either small businesses, a couple not-for-profits, but the rest of those are trusts. So whether that's a special needs trust or like someone's estate where they passed away and now the assets are being held for the family members. We had a number of those this year that we had to work through. For a number of them, it was the very first time, and we had to explain the whole process of we're going to be preparing a return based on the income and the funds that are still being held for your benefit. Mm-hmm. Each beneficiary will receive a K-1, which is kind of like a W-2. It summarizes here is your share of the income and deductions, and whether that's reported on the trust tax return that has to be filed or on your tax return. Mm-hmm. Yes, for a number of clients, that was a very new process. In addition to, mom and dad are no longer here, or this family, we no longer have this family member. Mm-hmm. So they had the benefit of receiving these inheritance, but also kind of the additional, I don't want to call it burden, but responsibility of filing a tax return.
Mm-hmm. Yeah. And so sometimes I think people can be surprised and they just don't realize it. So just a reminder, kind of when something changes, when assets change from one account to another, especially if it's a trust, it could cause a tax return to need to be filed. Not always, but sometimes, depending on what type it is. Mm-hmm.
So, when you're looking at maybe estate planning documents, or you're drafting those for your family, or you've been named to act in the case of if mom and dad pass away, I'm named the successor trustee. Just knowing what your responsibilities are, making sure that's clear so that it's not a fire drill.
Mm-hmm. Yeah, no, that's helpful.
I'm just looking through the list here that you and I kind of put together. Some things that are changing will be, we have a number of clients who are young families, but their children are now near the end of high school, getting ready to go to college. So the child tax credit, and this has changed over the years, but the child tax credit is currently $2,000 per child, and that reduces your tax dollar for dollar up to $2,000 if you don't exceed certain income thresholds. But once your child is the age of 17 or greater, that changes from $2,000 down to $500. So a $1,500 difference just because your child is a year older than 16. Mm-hmm. So for a number of our clients, they're getting to that age or are that age. So we've let them know ahead of time. But for clients that maybe do it themselves, or those that are hearing this for the first time, that's kind of that sneaks up on us.
Mm-hmm. I guess kind of along the lines with kids, education credits, what there do people need to remember?
Yeah, so not in addition to the child being greater than 17 and that child tax credit decreasing, they're maybe going away to school. So we'll have tuition and education credits, which you may qualify for. For many of our clients, their income exceeds a certain threshold, whether it's, I think this year it was 170 or 180 for this coming year. When your income exceeds that certain threshold, none of those college tuition education-related expenses qualify for a deduction. So they're kind of in no man's land. They don't get to claim the full child tax credit. They don't get to claim the education-related credits. So they're not really benefiting at all, and they kind of feel like they kind of feel lost. They're like, oh, this is what the middle class feels like. It's often what I hear.
Mm-hmm. Yeah. Well, that's helpful just to remember that some of those things that might have applied or don't.
So that's either based on the child's age or their income. So one where you can still get a benefit and it's not phased out at all based on your age, the child's age, income levels, any of that is college savings plans, or 529s is the tax code. Mm-hmm. You can set that up. If you're an Illinois resident, you can use the Illinois plan, write directions, and fund future college education expenses. And every dollar that you put in there is reduced by 4.95%, which is the state tax level. So you can put in, so if you put in $10,000 if you're single, or if you put in $20,000 if you're husband, wife, you would save $495 or $990 on your state tax return.
Mm-hmm. Yeah, no, that's helpful. Yeah, just kind of, I think sometimes it's like, oh, if I don't qualify for this, there is probably another way. And so it's just learning and understanding, working with someone who knows all of the possibilities. So that's good. Yeah. Thanks for sharing that. Another age that I guess we kind of think of is kind of these RMDs, like the age 70 and a half it used to be, but now it's changing. Maybe just talk through, a little bit of those details.
So when we use that word required minimum distribution, or RMDs, the IRS is saying these are accounts that were strictly retirement. This is not your brokerage account or your checking account. These are retirement accounts. So think 401k or 403b if it's through an employer, or traditional IRA or Roth IRA if it's individual. Certain accounts have this RMD, and some accounts don't. So the Roth IRA does not, but all the others do. And when you reach a certain age, based on the calendar and your birth dates, you have to start taking distributions out of these. It's roughly 4-ish% per year, and that will increase, but it's over your lifetime. And once you reach a certain age, in this case, used to be 70 and a half, now it's 72. There's talk about it in the future maybe being adjusted back to 75. You have to take out roughly 4% per year from that account. And the reason for that is it was growing. You got the benefit when the money went in. It reduced your taxes or your taxable wages. It's grown what's called tax deferred, meaning you were never taxed on it over the years. But now when you take that money out, it will be considered taxable income, and you pay tax on it at whatever rate you're currently at. So oftentimes, if we're retired, we're maybe at a lower rate than when we were working. So it kind of works out.
Yeah. And that's a lot of the planning that really we try to get ahead of, to say, well, and to answer that question, are you going to be at a lower rate? Some people won't, some people will. And so what are the opportunities there?
Yeah. And then what's leading up to between when I retired and when these RMDs have to start, there's some planning windows that we call them, some opportunities to move money or convert money at really low rates. So yeah, a lot of planning opportunities. But certain things have to happen based on your age, based on the date on the calendar, all of that. So what has to be done and when is what we're looking at when we're planning.
Another one with timing. So this is kind of one, safe harbor. So again, people have maybe income early in the year, and they'll ask the question, what do I need to do? Kind of that safe harbor versus estimated payments. What should they be doing? I think there's, a couple little rules, or a rule that you kind of use to help people understand if they need to be. Maybe share a little bit about that.
Yeah, so this would be clients that have a balance due. Maybe their withholdings aren't sufficient or don't cover all their tax liability completely. What we want to make sure is that they reach what's called safe harbor thresholds. So the way to think about that, it's either 90% of the current year tax or 110% of last year's tax. And you want to do that in certain times throughout the year. Make sure that you've had enough either withheld from your employer, from your retirement accounts, or possibly even making estimated tax payments quarterlies throughout the year.
So that's making sure that you've paid in at least 90% or 110% of those amounts.
Exactly. So even if there's a remaining balance due, you've reached what's called that 90% threshold. You're now safe harbored, meaning that remaining balance due can be paid before or when you file your tax return, but there won't be underpayment penalties and interest accrued or incurred on top of that.
Okay. All right. Well, that's helpful.
Kind of a geeky way of saying make sure that you've had enough paid in either throughout the year or by certain quarterly timings throughout the year to make sure that you're not going to be, the meter's not going to be running on that unpaid balance.
And then you have an underpayment penalty or interest. Yeah.
Yeah. Because it's kind of like it's on top of having to write the check, you're now writing a penalty check as well. So no one likes that.
One of the last ones here is like rental property, things like that. Anything there specific that people need to remember?
Yeah, we have a number of clients who have owned rental properties over the years. They've been able to offset the income from that with depreciation. So you're able to take the property, divide it over a certain number of years, 27 and a half, and then allocate that purchase price and depreciate that. So oftentimes these rental properties have a tax loss. There's enough expenses, operating expenses, plus this depreciation to exceed or offset the income, and they're showing a loss. Some clients are thinking about selling now. So when you look to sell, we have to figure out how much is the property appreciated for, what is the sales price, what was the purchase price, how much was depreciated, what type of gain are you going to recognize on this property, and then how much of that gain is going to be long-term capital gains treatment, so very low tax rates like 15%, possibly 20%, versus how much of that gain is depreciation, and will we have to recapture or recognize at your tax bracket rate? So the higher, maybe 35, 37%, depending on your where your income puts your taxable income. Mm-hmm. All that to say is when people are clients are looking to sell their rental properties, there's a lot of calculations that have to go into it.
Mm-hmm. Yeah, and I think that's helpful because I think that's probably the one piece that people are usually surprised by the most is that rental property, the recapture of the depreciation, because it may or may not cause taxes. And so that's something usually that surprises people. So
yeah, and they're not getting penalized on anything. It's just you got benefit along the years that when you owned it. So then when you sell it, you just have to pay back some of that benefit.
Mm-hmm. Yeah. Yeah. Well, I think that's most of all of the kind of like items that we said, okay, here's what we noticed. Here's just some good reminders. If this affects you, these things. In general, I guess it was kind of nice that tax season actually ended at April 15th because a few years ago it was June. So at least it kind of stayed in its normal window.
A couple years before that. Yeah. So you give people more time to file, they'll take more time. So it just extends that finals week for me. Mm-hmm. But yeah, it's nice to be done April 15th, get back out where it's sunny and just kind of out away from my desk.
At least here in Chicago around Illinois, it's like cold outside and still wintry. So you aren't like missing a bunch outside.
Yeah.
But,
February, March, April, it's raining, snow, sleet. You're okay inside and you're okay to be outside later when it's nice out.
Yeah,
so, yeah,
exactly.
A fair trade.
Yep. No, that's true. And I think too, I guess something we've kind of talked about, a lot of people don't get their documents maybe until late February. Just an encouragement, if you do work with an accountant and you're getting them information, once you feel like you have most of it or all of it, like feel free to get that to them really as soon as possible because they can go ahead and get it entered and see what the result's going to be. And sometimes you're just waiting on one document or two document and they can at least go ahead and get it completed and then wait. And once you get that final one, just finish it. So just kind of an encouragement, really the sooner that you can get information to your accountant, the better because they can have that entered. And then it's just a quick wrap up, in March and April when everybody else, sometimes is kind of just bringing things for the first time. So I guess an encouragement, if you want to get it done quickly, coming in earlier, that can get it in and out.
No one said no to someone bringing in the documents early.
Exactly. So yes. Well, thank you, Steve, for joining us. This is helpful. Thanks for kind of recapping us. I think it's always interesting for people to hear what's new, what's changing, what do I need to be watching out for, and just paying attention to. So
in this episode, we were trying to condense it down, multiple topics down to a short podcast where we could probably talk at length at any one of those. So hopefully it was encouraging and maybe enlightening for whoever's listening to this to kind of understand what's going on behind the scenes here.
Exactly. All right. Well, thanks so much for joining us. If you want to hear more about how we as financial advisors think about things like taxes, be sure to subscribe to our podcast that you're listening to, Behind the Designs, on your favorite platform. Maybe you're someone who doesn't like tax surprises. You can download our free guide to tax saving strategies that you can work on throughout the year. It'll be linked in the show notes so you can view it there. So until the next episode, we'll see you later, and thanks for joining us.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced, fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.